Hello, everybody. I'm so happy to finally be able to present my full system walkthrough. This is something that I've been working on for a very long time. It's very challenging to get all of the things out of your head and onto paper in a way that is easy to understand um, because when you've been trading for a long time, it feels very intuitive, especially when you have tools to help you with entry and measuring range and trade management tools. And so it feels very intuitive, very second nature. Trading is an extension of you. At the end of the day, everything gets exposed in the markets, your ego, your weaknesses, your strengths. It's such an emotional thing. And so it's been very challenging. I've tried making a presentation like this in the past, and it's just been very difficult to really get the full um, system out of my head and onto paper. But I think I've done a very good job here. I hope that it is a resource for you to understand not only how I do things, but also how the framework that is required to have your own system. Because at the end of the day, my goal for anybody who I mentor or I just chat stocks with is to help them develop their own system. Okay, and you'll see a theme with my slides, which is everything has to align. Okay, so your system must align with your lifestyle, your personality, your psychological makeup. So this system is my system. Okay, and so what I want to do is just do a brief overview before we get into it. So for me, a trading system is the accumulation of edge, execution, and routine. They work together to create consistency and confidence. So, in my opinion, every system must have um, an alignment with psychological and lifestyle. Without those two pieces, the system will not work. As I mentioned earlier, trading is an extension of yourself. Risk management must be embedded in every part of your system. So everything you do must come from a place of risk management. Okay, I don't like to talk about management as an isolated category. It is in everything we do, and I think I do a very good job at the end of this slide show that helps articulate exactly how I view risk management. It's inputs and outputs, and your routine and all the inputs and your trade feedback all feed into your risk model. But more about that at the end. Trading system is built on trend following with strict rules and psychological alignment. Okay, so I'm a trend follower. I use strict rules, and it's all aligned with my psychological makeup. So some of the key components: compression and expansion. All my setups are based on compression and expansion. My entries, my exits, all mathematical based rules. And the system is repeatable. I think without a repeatable process, you are going to be random, and randomness will result in more randomness. Um, Last little note here is that this is my system. It's tailored to me. Use this as a framework, but build one that reflects you and how you want to approach the market long term. Okay, we need to get out of thinking of today and think of the long term survivability in the market. Okay, so I want to share a quick story. So I want to share how I was misaligned. So in my early days, I had a margin account. And so I did not have great success with the margin account. I certainly did not need that amount of rope. I hung myself. Of course, many of us do. They give you too much of a leash. And like they say, when you're a kid, I give you an inch, you take a mile. Trading in the very beginning on a margin account is very toxic, to say the least. So I switched from a margin account to a cash account because I was struggling with over trading. In hindsight, it was likely just a symptom of running a poor system early in my journey. So on the new cash account, I was profitable. I was making progress, but I wasn't making enough progress to really justify all of my effort. I was running a low win rate, high risk reward strategy. The problem is on a cash account, it's not set up to have a ton of trades. You really need to be more thoughtful and take less trades on a cash account. But when you're trading a system that is a high volatility system, which is a low win rate, high risk reward, it just doesn't really work on a cash account because a lot of the moves fade in the early in the morning, or you get stopped out only for it to reverse, and so it eats up all your available capital. And by the end of the day, or by the midday, where the trend has started and the real move has began, I was out of cash. And so, does a low win rate, high risk reward system work? Of course it does, but it doesn't. It did not align with me, and so I was stuck in a loop. And I was running a system that relied on big home runs, but I was treating every trade like a base hit. That was my psychological makeup. I didn't like having a lot of open P&L. I like making 2 or 3 R and then being done. So I was running a system that required big home runs, but I was treating every trade like a base hit. It wasn't that I was failing because I lacked discipline. I was failing because the system didn't fit my reality. Everything was misaligned. The strategy, the tools, and even the time of day I was trading. Once I finally aligned my system with how I naturally operate, everything started to change. Okay, so we're going to jump into section 1, which is setups and edge. So the guiding principles, expansion. So I'm looking for strong momentum stocks. I'm looking for contraction. I'm looking for momentum pauses and price to tighten. I want to see obvious levels of support, and I want to see low volatility pivots being built. So in that little consolidation, I want to see a pivot being built. And I want a strong stock. I want the stock to show relative strength. I need a stock to has liquidity, clean order flow, enough size to trade with confidence, and I definitely want to trade stocks with high ADRs. The daily ranges are important because for the higher ADR stocks, it gives you an opportunity to grow your account quickly. I typically trade stocks with ADR of 4 or more. So let's talk about contraction and expansion. So during a trend contraction, the daily ranges will form a consolidation. This pause in momentum can establish support and resistance. During that range contraction, the daily candle ranges will become smaller and more narrow each day in the consolidation. This signals decreasing volatility and a consolidation within the larger trend. So we're looking for stocks that have strong momentum and are narrowing. Each day is getting smaller and smaller. And then the breakout, right, is coming from the expansion out of those tight closes. And so as the price ranges for each day get smaller and smaller, we're setting a level of support and resistance. When the price breaks through that in that bar, right, that daily breakout, that bar starts to expand greater than the ranges of the previous days. That's the expansion. So we're looking for contraction and expansion. And when you require narrowing ranges and tight closes before the breakout, you greatly improve your chances of your success. So what are the setups that I trade? I trade 2 setups. I trade a continuation breakout. A lot of people just call them pullbacks, but I don't focus on necessarily trying to get in on the pullback. I'm looking for the breakout out of the pullback, but I want to make sure that I'm on the day 1 of the new uptrend. So what are some key characteristics? Strong and persistent buying, orderly breakout. I want to see the EMAs flattening out. I want to see 2 tight days, and I want to enter when the 4 EMA is ticking up and the price is pushing past the previous 3 to 5 days. And so the next setup that I trade is the gap up delayed entry. So this is very simply, there's a big strong gap up. In the next 2 to 10 days, I'm looking for the same exact thing as the pullback. I'm looking for nice tight closes, narrower ranges, and then a breakout out of that. But I want to see that within the 10 days of that first big gap up. And typically what happens on these big gap ups, very rarely do they go and never come back. A lot of these stocks that have big gap ups will stay in that range for another, again, 2 to 10 days is typically how far the range will be built before it moves higher. And so I'm looking to enter when it's moving out of that delayed entry. So what makes a strong gap up? I typically want to see a stock that's made a 10% change with 200% volume. And the delay entry will happen 2 to 10 days after that big gap up. So this is just a very simple chart of how price moves. I'm looking for gap ups out of stage 1, and I'm looking for continuation breakouts that occur in that stage 2 uptrend, and these can repeat over and over again for the life of the stage 2. Typically, a growth stock will last 18 months to 24 months in a stage 2 uptrend, and so there will be many opportunities to find continuation breakouts, and even sometimes they have gap ups during that stage 2. So this system is fantastic because it's built around natural price action. So how do we execute? Okay, so the guiding principles is, first off, no setup, no trade. That is one thing that I cannot stress enough, is we do not take trades just to take trades. We need high quality setups, and that is how we execute with confidence, because we trust what we've seen because we've done the work and we know the data, so we understand no setup, no trade. We're only going to trade when we have beautiful, wonderful setups. Process over outcome. If you do everything right and you still lose the trade, that's okay. You want to focus on the execution, not the results. One good trade at a time. We are really definitely focused on quality over quantity. You have to let the edge play out. When you start buying and selling the same stock a couple days in a row or a few times in the same day, really overly managing, you are just creating more volatility in your own life and in your own account. That's necessary. You want to just focus one at a time. When the market is doing really well, you can push it 2 to 3 open trades at a time, but really with the way I like to trade really big and just focus on one at a time and just let the execution be the main focus on the way we look for our results. Okay, so what I mean by that is when we follow the process and we do one trade at a time, we're just executing. That's all we're doing. We're just executing. We're operators. Okay, and that's what I mean by one good trade at a time. Price first. So we want to trade what we see, not what we hope. We want to stay in sync. So that means that we want to max execution frequency with the market rhythm. So if the market is super volatile, right, we probably want to back off on new buys. And when the market is trending really nicely, we can kind of, like I said earlier, push the number of trades. So instead of one at a time, maybe 2 or 3 at a time. But that's only when the market is giving us that opportunity. So we need to stay in sync with the rhythm of the market. Losses are accounted for. So before you enter the trade, you have to assume that you've lost the money. Okay, and that helps with the mental side of losses as well. You have to detach from P&L. Yes, P&L is the reason why we're doing this. I understand that. I do look at P&L, but I don't have an attachment to my P&L. The trade decisions are what dictate the account performance, not emotions. So just stick to the process. Back off when things are not going your way, and push it when things are going, and the P&L will follow. You don't want to force it. Discipline may mean you have to wait for weeks. That's very hard to do. I struggle with it. But when there's no setup, then there's no trade. And of course, consistency over brilliance. We want to repeat execution. A repeatable execution will always beat luck. That is my guiding principles on this. Okay, so entry process framework. So typically I want to wait 30 minutes. I want to confirm the direction. So I want to make sure that price is truly pushing higher. It's not staying in that consolidation. It needs to push past that consolidation. It needs to push past the previous 3 to 5 day closes. And I'm always paying attention to the ranges. So I want to check where the price is in the context of the 9 EMA and the 21 EMA, as well as the 50 EMA. I also want to make sure that the daily range is expanding. If the daily range is not expanding, then that's not a breakout. I need to apply my risk model. Okay, so I've got my setup. I've waited 30 minutes. I've confirmed the price is pushing higher. It has moved out over the previous 3 to 5 days. ATR is all good to go. It's not too extended. Now I need to check in with my risk model. Am I allowed to push 0.5% of risk? Am I allowed to push 1% of risk? Where's my risk model? How much am I buying? So that will lead me to sizing correctly. And then volume. So volume at entry is not as important as volume at close, but it's something we need to pay attention to. And lastly, discipline. If things are not in order with these steps, just back off. It's not a big deal. If you've waited 30 minutes, the price is pushing higher, it looks really good, but your risk model dictates that you can't put on another trade because you already have 2 open trades, then no problem. You need to be disciplined and pass on that trade. So that's the framework. So let's go into breakouts using the EMA structure. So not every breakout needs to be followed using the 4, 9, and 21 EMA. However, I do use that as a sense of guardrails because I want to make sure that the EMAs are flat. I want to make sure that 4 EMA is ticking up. I want to make sure that the ranges are nice and tight and that the price is moving higher, like I've previously mentioned. And so that's how I use the 4, 9, and 21 EMA as a way to structure breakouts. I like to look on that left side of the trend. I want to see the moving averages expanding, right? They are separating from each other, which means that it's a very strong, persistent. And then I want to see them pinching, getting tighter. That means that the volatility is decreasing. And once they re-expand is when the entry should be taken. And then, of course, I want to see price within the top 30% of the day at all times. I don't ever want to see that fade lower. Now, if we don't want to use moving averages, that's fine. We can use purely price action. Everything is the same. We want to see clean, orderly momentum. I want to see 20% as a minimum momentum leg. I want to see it orderly. That means that it's day after day buying, strong buying. 3 to 10 days, same exact thing. We want to see narrowing ranges and tight closes. And the entry is going to be once it breaks above that near-term resistance, again, all the same rules apply. I want to see it pushing higher. I need to see the range expanding. I want to see volume at close. And I want to see the price stay within that high all day long. So nothing changes. One is using moving averages as kind of a structure, and the other one is not. But everything is exactly the same. Now, there's 2 types of gap ups that we can trade. So the first one is a strong close. And the strong close will have a minimum of a 5% gap up, minimum 10% change. I want to see volume at minimum 100%, ideally 200%. And I want to see a close in the top 50%. That's what makes it a strong close. And the delay entry will occur 2 to 10 days after that big, strong gap up. And all the same rules apply. narrowing ranges, too tight closes, the price pushing past the resistance, closing on top, volume coming into the close. Everything else stays the same. The only difference is having that gap up as that kind of precursor within that 2 to 10 day window. Now, if we have a weak close gap up, that is when the stock does the big gap up. It has strong volume, but it closes weak. So it's closing either negative on the day or it's closing on the lower 50%. And what we do is we treat these a little bit different. We want to see an entry really in the next 1 to 5 days, and typically it will have this this hookup here where it's a strong reversal. And what happens with that strong reversal is you're catching a lot of people off guard when it starts to reverse. And so what happens is on that very first day of the gap up, you set your alert for the close. And the next day, you can use that close as a trigger. If it closes lower, then you just move your alert to the top of that next day. And you repeat that process until the price closes below that 21-day EMA or until it triggers. So in this case, you had that weak gap. You would have your alert set here. The next day, gaps down, closes below it. You move the alert down. That's your alert there. It reverses. You get your alert and you take your entry. I typically like to set my alerts using the 1 hour chart when it comes to weak close gap ups. So how do I use ATR? Well, when I'm evaluating entry risk, ATR helps define how extended a price is from key reference points. A common rule is to avoid entries that price has already moved 1 ATR for the day. A lot of people will mistakenly accuse that action as chasing, or the stock has already broken out. However, not all extensions are created equal. In early stages of a new trend, price must be expanding to qualify as a expansion, and that naturally creates some extension from the low. This is the paradox. For a trend to begin, expansion must occur, which by definition creates some stretch. That's why we don't judge extensions solely by the low. Instead, we focus on the relationship to key moving averages, the 21 EMA and the 50 SMA. So this is a visual I would like everyone to really focus on. So I'm calling this a jack-in-the-box ATR entry framework. And what this is doing is giving a visual cue for the paradox that I just explained. So if today's range is smaller than the previous day's range, both the candle body and the full day's range, then the stock is still compressed. It's still basing. So there should be no entry. Now, once that candle body range, the candle body range and the daily range is greater than the previous day, that's where you're getting that expansion. Now, this is valid as long as price is within 3 ATR of the 21 EMA and price is within 5 ATR of the 50 SMA. That is giving us a breakout near support in the context of ATR framework. So let me repeat that. The candle body range and the daily range must be greater than the previous day. That's telling us that today the stock is having a range expansion. This is valid as long as price from the 21 EMA is less than 3 ATR and price from the 50 SMA is less than 5 ATR. Now, if price is greater than 3 ATR from the 21 or greater than 5 ATR from the 50 SMA, the stock is likely trending or it's too extended. So no entries should be taken anywhere near that, even if it's a perfect high tight flag. If it's more than 5 ATR from the 50 SMA and 3 ATR from the 21 EMA, I'm not taking that. Okay, but this is something I really want people to understand. The price has to be expanding on the daily. Today's breakout candle must be expanding from previous day. And if it's expanding with the context of being tight on support, it's valid, even if it's traveled 1 ATR already. So where do we place the stop loss? I always use low of the day. However, if it's really volatile and there's a lot of shakeouts and that kind of stuff, you could use previous day or the consolidation low as a way to use your stop loss. Some people will refer this to as a logical low, but the adjustment is valid as long as the risk reward is not skewed. Typically, low of the day is my go-to. Position size. So I always use risk as the amount of money I'm risking, right? So I don't think of position size in the context of portfolio allocation. I look at it as how much money is at risk, because trading higher ADR stocks, sometimes you have a much smaller position size. It could only be 5% of your account, but you could be risking $500, or you could have a high price stock, and you could be using 30% of your portfolio and still have that same $500 risk. So those numbers are arbitrary. The only thing that matters is the dollar risk of your account. So typically, I will use 0.5% of risk. Okay, so 1% of my total account I'm willing to risk. And so I have some examples here, but I always recommend using a position size calculator. It's really the only way to do this quick and efficient and accurately. So some simple sell rules. So I typically always base sells on my risk reward return. So if I take every trade off at 2R or 3R, that means I'm always getting 3 times my money back. Okay, so that's how I really grapple with selling. It's all math for me. Selling is math-based. It's not emotional. I want to use base hit mentality. So I want to lock in gains consistently. 3 to 5 days, take the gains, get out. Risk control. I'm aiming to keep my total account heat low. That means I don't want 5 positions open at one time. If I have stop losses at break even, that's fine, but typically open heat. So the amount of actual dollars at risk, I always want to keep that low. I typically don't like to push it past 2 during normal trading. When it's really good, I'll push it to 4, maybe 5%. But typically, I'm at 2% max. Partial sells. I love taking a quick 33%. Typically at 2R, I'll take 33%. That's pretty nice. ATR-based exits. So if price is showing some extensions off those 21 or 50 EMA, I'll take a peel, or I will totally take the trade off if I'm getting too extended. And what this does is helps with liquidity management, because what it's doing is you're turning over your account. You don't have money locked in for a long time, and it's giving you a constant feedback loop. Every exit becomes a data point. Did it work? Did it not work? Why not? So I'm always constantly getting input. Always getting input. So we already touched on this, risk-based selling rules. So I want to compound my gains by catching 2R and 3R moves, and just turning that over and over and over. And what that does is it helps lock in gains before a pullback. It keeps your average win size pretty even keel throughout, so you don't really have these big winners. Like I said, I don't have a low win rate, high risk reward system anymore. I'm trading at a high win rate, which means that I need to take profits much sooner. So I'm constantly turning over my account, turning it over, because what I want to do is want to make sure that I don't have a big discrepancy between my average trade and my best performing trades. I want them all to be fairly the same. And this helps put me in a rhythm, okay? It helps me keep in sync. I'm buying 3 days, I sell. I'm buying in 4 days, I sell. Boom. And that helps me with my emotions. ATR based, we've already covered this. So if things are getting too extended, 5 ATR from the 21, 7 ATR. So 5 ATR and 7 ATR would be definitely spots to sell at. Typically, your entry, I got a little confused there. But yeah, 5 ATR and 7 ATR would be your signals to sell from. We touched on this. So peel and trail. So how does that work? So typically what I want to do is I will take the entry. Once it's moved to 2R, I'll take a peel. 33% it works out. And then I move my stop loss up to the entry. And that helps protect the downside. And again, what that does is it locks in gains quickly, and it's keeping your equity curve upright because you're constantly you're constantly adding closed trades or locking in gains always, constantly. Boom, 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 boom. And that helps with my mental, like I just said. Let's talk about routine. So this is probably the most important part of all of this because this framework applies to whatever setup you do. If you're a short seller, if you're a 3-minute time frame scalper, this is what you need to build your system on. So it's your situational awareness. So you want to review breadth, you want to review your trades, and check in with your emotional state. You want to pay attention to your watch list. When you're going through your watch list, what is going on? You want to be paying attention to how many names are on your universe, how many names are on your focus list, which stocks are holding up the strongest. Is your leaders list growing? Is your leaders list shrinking? You need to be paying attention to this. This all goes into your routine. This is what you need to do, and this is how you stay in sync. You want to set alerts. You want to make sure all your tools are working. You want to constantly be reviewing your performance. Daily, weekly, monthly, you want to review your performance. Keeping on track with your edge. Is your edge in favor? You'll know by your closed trades. And then your risk model. Okay, VTG, Voyage Trading Group risk model. My risk model is based on all of these inputs. All of these inputs go into my risk model. So let's talk about situational awareness. We have 2 indicators. The primary indicator is your performance and your emotional performance. Okay, these 2 things are very important. You need to check in with yourself and check in with the market. Okay, your market indicators. I use the NASI. I use net highs. I want to look at percent of stocks above 200 moving average. Also look at the RSP and the QQQE. That's how I determine both how I'm doing and how the market is doing. For the NASI, I like it to be trending higher. I'm actually fine with it being in a little bit of a overbought state. Net highs, I want to see constant net highs, always net highs. Percent of stocks above the 200, I want that to be above 50%. That really shows me that there's a broad participation. And RSP, QQQE, those are the equal weight. That shows broad participation. Watch list. So my universe is stocks above $3, ADR 3% above. Average volume is 500,000. I want the price to be above the 50 SMA, and I want the 50 to be above the 200 SMA. That's my universe. Okay, I run that scan one time on the weekend. From there, I will filter down for stocks with the same criteria, but they need to be 30% performance in 1 month, 50% performance in 3 months, 100% performance in 6 months. Okay, I do this on the weekend. Now I have a universe that I've now shrunken down to high momentum. From there, I review for leaders. I do this every day. I want to keep a list of 20 to 50 stocks that are forming buyable setups. Okay, from there, I look for 1 to 10 stocks that are tight and are ready for entry for the next day. So you see how it's like a funnel, and the funnel leads us to the focus list. And I do the focus list with just my eyeballs. I just look at it with my eyeballs from the leading list. What's ready tight? I set the alert using my eyeball. Every day, I want to review which stocks have made 20% move in 1 week. And I also want to look at what has made 10% on 200% volume every day. I look at these two scanners every day. This is helping me find big gap ups, big reversals, strong candidates. Typically, if there's a big stock that's moved 2 or 3 higher ADR stocks that's moved 2 or 3 days, and now getting tight a little bit, that might give us an opportunity, something that we may have missed doing the weekend scan. So this is kind of catching the loose ends from really strong momentum stocks during the week. So what is the workflow? Well, so you have all of the results. Okay, you go through the results and you identify leaders. From there, you identify a focus list. That is the workflow. You go wide and you narrow it down. The leaders list is a really important list because these are stocks that you want to get involved if they tighten up. It's important that you're really focusing on that. This is not a list of stocks that are way gone or way in a downtrend or nowhere close to setting up. These stocks need to be reasonably. It would be reasonable to say that they're going to set up in the next few days or few weeks. If it's a stock that's in a downtrend that used to be a leader, that's not a leader. If it's a stock that you traded 4 months ago that you want to trade again because you made money on it, but it's not showing current strength, then it's not a leader. So this is all very practical, not emotional. How do we set alerts? So I like to narrow it down to a 1 hour chart, and I'm just very simply looking for where is there support and where is there resistance, and I set the alert. It does not need to be exact to the penny. It needs to be very obvious. If it's not obvious, then it's probably not support and resistance. I think that's what is a lot of people get confused about, is they just draw a line, even though they don't feel strong about it, they don't feel confident about it. I'm just going to put a line here. Well, it needs to make sense, okay? And it needs to be very obvious. Trading shouldn't be difficult. Trading is difficult, but it doesn't need to be difficult. If you have, if you remove the emotion out of it, you focus on a system and a process, it becomes routine, okay? So how do we do a performance review? So every day we want to first check in with your emotional state. If you're really stressed out, you're really having a hard time, you need to back off. Are you adhering to your process? Are you having market volatility or personal volatility? This is a daily check you need to do with yourself every single day. At the end of the week, you want to look at your win rate. You want to look at your risk to reward stats. And at the end of the month, we'll also look at how long were we in trades and how many trades did we take. All of these things are great for you to do. I highly recommend doing an end of week and end of month. A lot of people will only do end of month, and it becomes very cumbersome. Let's talk about that risk model now. For the VTG risk model, it's driven by inputs. So you have situational, I need to fix that. Situational awareness, that's your breath. How you doing? Your watch list, is it growing? Is it shrinking? Are there great names on it? Or are you just putting names on it just to feel special? And then your performance review. You need to watch your trading results, check in your emotional state, and definitely your process adherence. This is what's going into that risk model. So these are your inputs, and then your output is your signal. I think this is really important. This is that part that applies to all trading systems. You need to have inputs that drive your outputs. Okay, let's talk about my progressive risk. So I think of risk as a slider. So typically, my yellow light is normal trading. A lot of people will have yellow as a level that's below normal trading. For me, all trading typically is yellow trading. Brief periods of green and long periods of red. When the red turns on, it's a serious bear market. So I'm typically always in that yellow. But what I do is I use it as a slider. So that 1 to 2, I could have a few steps in between. And then from 1 to 0, I have a few steps in between as well. So let's talk about 0. This is red. This is total bear market. I don't really short the market. I will use things like SQQQ. But other than that, we all know what a bear market is. You want to be on red way before that bear market hits. And your slider will get you to red before that happens. Because before you ever get to red, you'll have a number of trades not work for you. And that will slide you to that red. And then typically the market will then have a major sell-off. So doing it with a slider approach, with you being at yellow for most of the year, you'll slide off to red before the market sells off, is typically how that works. And the mindset is I'm just going to sit on my hands and wait for clarity. So 1. So typically I'm at a risk model 1. I'm actively trading, but I'm really focused on risk. And typically we have some follow through. Things look great, but then things look okay. Not super green, not super red, just normal trading. And typically I'm at a 1/4 to 0.5% risk per trade, and I definitely don't like to get more than 2% of open heat. Now, I can slide that over. Let's say things are picking up. I want to slide it over. What I'll do is, instead of having 4 0.5% trades open, I'll have 2 1% risk trades. And if that's working, then maybe I'll consider going to 4% open heat. But typically, at that point, I will be at a green signal, which will let me take 1% risk per trade. I'll swing 4% of open heat. I'm willing to take more risks. I'm pushing size. Trading feels easy. Okay, and so that doesn't happen all the time, but when it does, you know it, and you know that it's a gift and it's a small window. The last section is just tools. And so I couldn't do what I do without a position size calculator. I couldn't do what I do without being able to measure my ATR extensions or my daily range expansions, your relative strength indicators. I have a trend intensity that gives me a trigger when the trend expands again. You can code something like that if that's something that fits into your system. I have a portfolio management tool. It's a Google Doc, it's a Google Excel sheet that I track my entries, my stop losses, my open heat, my open P&L. I do all of that. I calculate my risk reward. That's how I know that I'm at 2R and I'm at 3R, because I have a document, I have a Google sheet that I'm inputting every time I take a trade. I put into my chart the entry and the stop loss, and then I have it calculate where's 1R, where's 2R, where's 3R, and then it lets me know when I'm at 2R, 3R, and then I can take my profits. And I have various scanners and tools that I use. I have breakout scanners that run throughout the day. And what this does is it really helps me avoid entering too early. I'm getting a mechanical trigger to let me know. And then what that does is it removes some bias out of that entry and lets me really just focus on the process. You have to have tools. So when you put it all together, your edge is a setup that repeats. Your execution is your entries and exits with risks, and your routine is your daily inputs that feed that risk model. And what is that risk model? It is the output that guides exposure. And that is a full system. And when you have your system plus your psychology, you get clarity, confidence, and conviction. And that's when you can trade free and break free of all of the gut feelings and all of the randomness that is probably causing you a lot of stress in the market. So I hope that you learned something. I hope you will apply this into your system. And I really appreciate if you have any questions, please let me know.